All right, so the dollar index is our daily chart. And I mentioned, obviously, this is, for the folks that were with me on Monday, so you're going to have to just take that in stride if you weren't part of that group. But nonetheless, the idea is that we were looking for a bullish dollar. We've been bullish on dollar for a while now. And I was mentioning that we would go for the full 100 level. We hit that. I mentioned we would go to 101. And I mentioned how we could probably draw back down in after hitting 101. That's one of our targets. And the second one was going to be 101.947. And just for clarity's sake, the other one was just short of 103, but I just rounded it to 103. I'm not calling a top here in dollar. I don't do that. I'm staying with the underlying narrative that dollar should keep getting pressed higher. This is just in my mind, right now, until proven otherwise, just a retracement after hitting another premium level. Now, what changes my mind on about the dollar being bullish? If we go below these lows in here, that to me signals a potential turn or intermediate term high forming in the marketplace. And it would take a little bit of time, even after that, for me to change my long-term bullish stance on dollar. So what am I saying in short? I'm allowing for sloppy price action, as I mentioned on Monday night's commentary for the private group. I know this is going to be confusing for me. Oh, you're confusing me. Just deal with it, folks, okay? It's free. Okay. So I mentioned on Monday night that we could probably see some sloppy price action. And I'm not in a hurry to make decisions about actually going in and taking live trades again yet, because we just came off Passover. There's a lot of holiday volume, and a lot of money stays on the sidelines during that week. I know it may not seem practical to some of you, but it's true. So we have to work out that little bit of lull in the volume. And I give that a few days. And in fact, it might even be the rest of this week. And then maybe next week, things will be a little bit cleaner in terms of the price action. So higher prices on dollar, that's what I'm looking for until proven wrong. And we've obviously seen two targets here hit the 100 level and the 101 hit rather handsomely. So I have that level highlighted here. We'll drop down into the hourly chart now. Okay, you see how we moved up in, hit the 101 level. Look what they left here. See that? See how clean that is? Price does not like to leave those types of formations in its wake. So in other words, even though we had a market drop, even though we took out a swing low, even though we had a fair value gap, even though it came up there and filled it in, look at the bodies respecting that. It's beautiful. It's beautiful price action. Yes, there's a little bit of movement above it with the wicks here, okay? But the bodies, look how it's telling the story there. That is algorithmic price action, okay? That is delivered by an algorithm. That is not buying and selling pressure, okay? That's not supply and demand. It's not harmonic. It's none of that stuff. It is the algorithm delivering price on its terms. And we as speculators have the fortunate opportunity to be participants in these opportunities when they are presented. But they're not going to be profitable because of things we learned in books. Indicators didn't drive markets higher or lower. Any retail logic did not drive markets higher or lower. These markets are going to book, print, and deliver on the basis of its algorithm. Now, either you understand that and get in line with that or get run over. If you're winning in any school of thought, and I don't care what it is, I've done all of that stuff, okay? The only time that I can look back and see when my trades were profitable is when I was in line with what the algorithm would do anyway. Doesn't this low being broken here in that fair value gap hits it right there? We have another higher fair value gap. So what does that mean? It could trade up into that, but we're looking for the entry in here. And then look at that. Now, is this a 1 minute chart? No. How about a 2 minute chart? 5? No, of course not. 15 minute? Nope. It's an hourly chart. And that same fractal nature of that pattern I'm teaching you in the YouTube community, it exists here. Now, if we look at the high and the low, that whole price swing here, from that low up to this high here, that parent price swing, if you put a fib on that and find out 50% of that, it's going to put you about in this area. So I'm eyeballing it, but ultimately right below that low. Isn't it interesting? That's exactly what I was teaching you in the YouTube model. But I'm teaching you to use it on any market. So we have a break in structure here, fair value gap here. The volume of the move is inside the bodies of the candle. See that? We always allow for some inherent price action with the wicks and the tails of the candles, but we're looking for the underlying narrative. It's likely to go back in here and fill this one single candle that created that imbalance. This candle's low, this candle's high, that small little imbalance right in here, it goes up and fills in that, spends some time there, then breaks aggressively, attacking all the stops below here, 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 fills in the gap, and then goes right below that low. Why? Because equilibrium exists between this low and this high. Why did it drop like this? Because it hit our second target of 101. And plus, it's 100 points or pips above the full 100 level. Where's it at? Good grief. Here it is. Okay, so we really stretched above it, and then we had this. Now, to me, this looks a little bit like them trying to produce this sentiment idea that the dollar has topped. I'm not convinced of that yet, okay? It could, and I could be absolutely wrong, and these highs are maybe the ones that top the dollar. That always exists. That's where I can be wrong. I don't mind being wrong by not trying to pick tops and bottoms. I don't mind that, okay? It doesn't make me feel inferior. It doesn't make me feel like I don't know what I'm doing. It keeps me on the right side of institutional order flow. Institutional order flow is rooted on higher time frame bias, okay, and that being for the dollar, it's bullish. Well, it's bullish in my opinion, let's say it that way. All right, so 15-minute time frame, we finally made it. Sell side liquidity resting below these lows in here, swing low, and we had sell side resting below here as well. So as I mentioned, too clean up here. They're really building the idea that this is resistance. I don't think that's the case, and we might want to go a little bit deeper. If it retrades back, let's go back up to this here. We could trade back to the 100 level, maybe sneak below it just a little bit to make everybody think this is really done. If I was making the market for $1, I would take it down below 100, dip it into 99.95 or 92 in that area here, and then start to work it higher. That's how I would do it, because it would convince everybody out there that the dollar is probably topped, and then I would take it the other direction. You know what I'm talking about. It happens most of the time in your trades. You get in and you take something, all of a sudden, it's not as bullish as I thought it was, and it went lower. I've been there, folks. I'm not making fun of you. All right, so here is that hourly fair value gap, but now look at it with the lens of the 15-minute time frame. So we have this area here, but then we have this imbalance right there. So it comes up a little bit deeper, closes that in. What do these two up-close candles represent? A bearish order block. So we can use the low of the lowest up-close candle and its opening price. You draw that out in time, hammered it. Why is this an order block? Well, it's because it's where price was delivered on the upside, even though it's indecisive candles here. That up close, right before this displacement to the downside, it's not, listen to me folks, it's not what these folks are taking from my videos and writing books on Amazon. But why are these candles here on order block? It's because we had the change in the state of delivery where it's already dropping, then it goes higher. So the algorithm is putting it's kind of like a bookmark. Okay, this is where it will want to refer back to in the future. Okay, think of it like that. So, like say you're reading a book, okay, and you're in this chapter, and all of a sudden real life kicks in, you got to go back to work, or you can't read anymore because your spouse says, you need to do some things around the house. Hint, hint, nudge, nudge. So you have to stop reading. You put your little bookmark in the page where you're at, okay, and then you come back to it later on. Well, when you stop reading, that's essentially where this candle closes. And then all of this happens while you're away from the book. And then when you come back to the book, here, you pick up with the storyline. And what was the storyline? It was dropping. It just had a little pause in here, and then we go right back to the storyline. So maybe that analogy doesn't fit you, but it makes sense a lot of ways to me. Okay, it's like a reference point that the algorithm will go back to, because the algorithm doesn't know where your specific stop is at all times. Your broker does. But the algorithm doesn't necessarily know where your stop is or my stop is at any given time. But it's based on the logic that is really promoted and regurgitated all the time in books and seminars and course teachers and things. Put your stop rate above the high. Put your stop rate above the highs. It's always the same thing all the time, and it doesn't take a rocket scientist to sit down on a chart and say, yeah, well, if it's been dropping, find a short-term high most recently, and that's where right above that there's going to be buy stops. For anyone that's short, they trail their stop loss down. So what does that mean? It's like anyone that went short up here and was fortunate to be right, and it does this move here, starts to break down, their stop would be moved from here to right above this short-term high. That trailing stop loss mentality, okay? I'm not a real big fan of rushing my stop, and that's why I teach the way I teach, because I'm looking for things that make sense, and I'm not trying to strangle the marketplace. But this order block here is a change in the state of delivery. It's been going lower. It's likely to go lower. This displacement qualifies that order block because it creates a fair value gap, and the narrative is likely to go lower. Now, this lower movement is short-term in nature. It's counter long-term bias, okay? So here's the hourly chart on Euro. Market traded down aggressively here on this day. swept below that low. Here's that daily low. Let me go back that way because I've done a lot of talking, probably didn't make note of it. That daily low is 1.0806 in 1 pipette. That's that line right here, okay? So in an hourly chart, it breaks down, slams below it, and then look at all this price action in here. See all that? This is during Passover week, last week when I wasn't trading, and we hit that same low here. We rally, create a fair value gap there, run right back up to the old highs in here, and optimal trade entry. From the high to the low, we went right up into a short-term premium. So as a short-term trader, going counter-trend, remember I was referring to on the dollar index where I have students that are contrarian. If I'm long-term bullish on dollar, they know where to go in and pick their shots where it looks like retail will see it as a reversal, and that's how they made their model. So I'm bullish on dollar. They'll wait for retail to think that that bullish dollar has topped, and then they'll go in and find their setups. So hopefully that made it more clear about what I was saying earlier. Well, what would that look like with euro? Well, it would look like this. We would have a run back down in to old support, which is the old daily low, rallies, creates a fair value gap, buy it in here, right back above the bodies of these candles into the 62% retracement level, because 62 and 79% retracement levels are what I teach as optimal trade entry range, but it's not optimal trade entry for the setup. Okay, so in other words, we could be a buyer down here and trade back up to the 62% retracement level, or the bodies, okay, round above the bodies of these candles here. Just pick the 62% retracement level and just make it really easy for yourself. But that would be a nice little run in here. It's not a lot of pips. I mean, it's, what is it, 20? 60 to 50, it's 10, 20, 30-ish, 30, 40 pips, thereabouts. Not bad. It's a bread and butter type setup. But that would be the version of a contrarian trade against the bias that I'm suggesting to my private group, which has also been shown to you in the YouTube community, being bearish on euro until we got below that low here. Let's go on to the euro dollar, 15-minute time frame. And you can see here, again, really nice fair value gap. This is what I was referring to on the hourly chart. It's just really clean here on the 15-minute. Now, when I say clean, what do I mean by that? We have a nice run up here. It returns back to that old daily low. And then we have what? Displacement. That real energetic run higher. That is algorithmic. When it creates this gap here, we don't care that it's still stretching up here. Now, as a new trader, or someone that is impatient, that doesn't have an understanding of what they're looking for, it will feel like an impossibility for them to say, I'll wait till it gets back down here and then buy. Because what will happen is once it does, when it trades down like this, they're not going to look at that and say, oh yeah, I feel good about that. They're going to think, man, this thing, what happens if it's going down below these equal lows? Because that's what everybody on YouTube is now teaching because I mentioned it. No. What's the narrative? We're short term, right now, oversold on the daily. Why? Because we took out that old daily low. We went below it. So now it's taken what out of the marketplace? Sell stops or sell side liquidity. So what's the market going to look for now? Buy side liquidity. That means it's got to go higher to get that. So an energetic move off that same daily low, and it creates that displacement. When it trades back down into that, I'm thinking, okay, well, it's created this short-term high. It's going to want to run back up into that. But even if it doesn't, if I just get above the bodies of these candles in here and reach up into that 62% retracement level on the hourly chart, as I mentioned right before I transitioned to the 15-minute time frame, we reached up into that 62% retracement level. So that would be an opportunity to be a buyer here and sell short, not sell short, but sell your long there and be done. All right, so we're dropping down to the hourly chart, and here is the E-mini S&P June contract. Market traded down into that short-term low, ran out sell stops here, or sell side liquidity, so it purged that liquidity. Then we had all this sloppiness starting the week, and then we dropped down and rallied up. Doesn't look too clean and clear in here, does it? It's okay. It's about to change. We're going to drop down the lower time frame because we have a bias. I mentioned on Monday that I felt that this was going to go higher and clear up all this here. And that was the draw on liquidity. Now, here's that part of the video I said when we get into the discussion about live sessions, what am I going to be doing? Basically, what I'm going to show you a clip of when I get to the 15-minute time frame, I'm going to show you the clip from Monday night's private mentorship video where I discuss, before it happened, where the E-mini S&P was likely to go, why I felt it was likely to happen, and I'm going to amplify that here so that way both communities can appreciate what it is that I'm going to be doing with intraday price action. The guys over in Goldman Sachs, and you've been with me for a while, you know who I'm talking about, they like to say that intraday is just noise. And one of those guys actually said he tried very hard to make it work, and if anybody tells you that intraday trading is profitable and you can do it consistently, run away from them because they're a con artist, okay? It's kind of funny that, I'm proving technical science, okay, because it exists. It repeats, but you have to know what you're looking for, okay? And I'm going to show you that here. I mentioned the opening price on the midnight candle, and I mentioned the opening price at 8:30, and there's a lot of confusion as to what that means and what am I supposed to be doing with that information. I'm going to cover that in this video too. But I want you to look at this hourly chart and just see this movement here to here. You see that? You don't have any reference points inside the hourly chart here. That's okay. I'm going to show it to you in amplification to what I was showing my group on Monday night before it happened. Do you see how level these two highs are here? See that? This is what I dub relative equal highs. That right there engineers buy stops. For anyone that chases this going lower, they're going to think that this is the area where resistance is. So their stop will be placed above that. Does it take rocket science to understand that? No. Every book tells every trader that reads the book that stops get above the old high. And this is resistance because it went here, stopped, went lower. It tried one more time here, and then went lower. So this is strong resistance. Now, granted, I'm not trying to make a case that hourly time frame is strong, okay? But there's a lot of people that trade in these lower time frames, and they'll see that as what? Formidable resistance. So they'll feel that this is safe. The market should keep going lower. They broke this low, so that means it's going to keep going lower. And when the price starts going sideways like this, slightly up, it's going to look like what to them? It's a bear flag. So they're going to look at this high down to that low and project that same movement lower as a measured move. And this type of thing happens because they didn't use the context that I'm providing you, both communities, understanding how the markets move from discount to premium, premium to discount. That's it. And then what PD arrays within the current market structure and what narrative. So what is narrative? What is that? Well, we have the market trading down into that short-term low, below old lows, about 50% of its daily range that I mentioned on the daily time frame. So we've purged the sell stops. Where's it going to go? Higher. Why? It needs to go to buy side because it's now collected sell stops. So smart money is going to do what? Offset those buy orders that they used to pair up with the sell stops below these lows. They bought those sell stops. So now they're net long. How do they get out? They have to sell them to willing buyers. But at this point down here and over here, who's going to be buying from them at a higher price? The buy stops that are resting above here. So you have to think algorithmically. How do you pair your orders? If you don't have this mindset going in before you click the enter button of your trade, you are gambling. You have no idea what you're doing. You're trying to guess. You're in there seeing what would happen if I did this. And when it works, you're telling yourself, wow, if I did that with real money, I could quit my job in 3 months. Wrong. And when it's bad, you're thinking, oh, well, I wouldn't have took that trade anyway. I'm really cool and astute. I'm an apt pupil of price action. No, you're a gambler. You're dabbling with a demo account and you're not learning anything. You're conditioning yourself to believe that these sensations that you feel, when it's right, it's skill. And when it's not, well, that was just you just playing around. You weren't really doing anything serious about it. And that creates toxic thinking. And it builds a false sense of security. And in certain instances, some individuals literally go out and say, well, I'm going to put live money in there because, I got lucky a couple times and I could afford, a couple $1,000 and I could do this and I could do that if I made that. And that's what everybody does. They fall victim to that. I don't want you doing that. You have to have a real reason why you're doing something, even in demo. Otherwise, you're teaching yourself to think, well, improperly about what it is that you're trying to do in these marketplaces. So the logic is we're looking for it to run above here. And now think about that in this area here. Here's the 19th on Tuesday. I told the group that it was likely to go to here. And I'll show you that clip when we drop into the 15-minute time frame. But now think about what does your daily candle look like if it's going to likely go up here and we're down here. It's going to create what? A little bit of a movement down, make the low of the day, then rally up to clean that level out. And we're not trying to predict the closing price on the daily candle. We're not trying to do that. We're trying to participate in a move in the morning session that gets us long, that allows us to run up into this area here. And that would be your target. You're not trying to get the move that goes all the way up to 45.90 if it was to do something like that. I'm not suggesting it is, but I'm just saying that you have to pick these periods in the marketplace where it makes sense for you to anticipate and expect a certain move to begin and originate in, and where it ends or where it finds its terminus. So, point of origin, terminus. Buy orders on smart money, sell orders on smart money. Retail, buy orders. Retail, sell orders. That's the continuum that goes between smart money and retail. You have to change your thought process about what you're looking at in the charts, and that is narrative. Looking for the daily delivery on that candle, Judas swing, buy below the opening price, expect displacement to the upside, run into liquidity, offset, sell to buyers, move to the sidelines, you're done. Now, what does that look like on a lower time frame? Here's the 15-minute time frame. Here is the relative equal highs, the buy side liquidity resting there. Look at this price action in here. What do you see? Pause the video. This is that moment where you want to study and look at it. Okay, I'm going to continue now. All right, so here we have this low. Why am I picking that low? Why not that low, Michael? Why didn't you pick this low, Michael? This here is a range that we worked in, and I mentioned this was brutal when I was discussing it with my students on Monday in its commentary. But this movement here, this is the most recent swing low. It rallied up and it created a higher high right above these relative equal highs. So there, at 0.1 to 0.2, that's your dealing range. Okay, I'm using that because it's the most energetic, most recent low and high. This is where I think the market's going to go up to, because I think all of this movement down here basically has accumulated all the sell stops. So now smart money's heavily net long, and they are sitting on all these, counterparty traders that either were knocked out of the marketplace and they absorbed all of their sell stops, or they're caught offside and retail's trying to go lower. It doesn't make a difference. I'm not suggesting that you should even waste any time trying to figure out what that is. I'm just saying that below old lows is sell stops, below old highs is buy stops. Just have it in mind. It's just that simple. Now, knowing that by itself is not enough. You need to know what is likely to occur. Here is the midnight candle in New York. Okay. How do you know that? Over here on TradingView, click this little area down here. It'll pop up a list of time zones and such. Scroll to New York. Always put your TradingView chart on New York. I don't care where you live. You do that. Everything I'm teaching you will line up. Midnight opening price. The opening price is here. Draw that out in time. And that's your New York midnight opening price. This is the price I want to preferably be buying below. Now, there are instances where the opening price will be lower, and then the market is trading higher but doesn't go back below the midnight opening price. This is why I said 8:30 opening price. 8:30 is when a news embargo lifts, and a lot of news comes in around 8:30 typically. And I use that opening price there. Now, in this instance, this is why I'm teaching it to both groups today, because this is kind of like just a dandy of a setup. It means it's really good. I like these types of setups, what I'm going to show you here. When it delivers something like this, it's almost like it's presenting it to you on a silver platter. Like if you really, really want a good little setup that's going to just be a real nice crackerjack, it just delivers nicely, it's this one here, okay? If we're bullish, okay, and I'm assuming that you'll trust me when I show you the video clip from my private mentorship group, folks that are in my private mentorship group. If I'm sharing something that was edited, if I've changed that video in any way to make it seem or sound like something that really didn't take place on Monday at the 13-minute mark of that video, please say so in the comment section, okay? You're welcome to roast me, okay? I'm only telling you that because the comment section is open on my videos. You guys can say whatever you want to say. I don't care. Bottom line is I'm proving it, okay? I'm proving it. That way you can feel comfortable learning from me. There's no sales pitch here anymore. Just put down all your reservations and just grab a pen and pad and listen. And I promise you, what you're looking for, it'll come. The confusion that you're getting about the opening prices at midnight and the opening prices at New York, 8:30 a.m. Last ditch for PowerofThree is 8:30. What does that mean? If the opening price at midnight, if you're bullish, is lower than prices trading at around 8:30 or after 8:30, then it's likely it's not going to be a factor. Then you use 8:30. If there is a day like this one here, where we have the opening price at midnight here, we're already below it. And after 8:30, we're below it again, still below the midnight candle's opening price. We're really in a discount. Like we're really, really cheap on the day when we're bullish. Now think about what I've outlined so far. It seems like a long way here, but everything I've discussed is paramount and crucial for you to understand why this is occurring, because these are the things that are going to repeat. Don't take my word for it. Start backtesting and logging your charts like this, and you will see these events repeating because it's algorithmic. It will not do it every single day, but every day it will be present in something. That's why I say with my motto, it's every week, every day, and it won't stop. It does not mean every week, every day, and it won't stop every single individual market, because you have to be able to navigate. Some days it may not happen in the futures. It might be in Forex, or it might be in bonds. So you have to be flexible in that regard. Okay, but every single week there's this type of setup. Every single week there's a setup like this. Inside this range, it moved from here to here, and then started retracing down after midnight. Notice that? So all of this here is a Judas swing. Judas swing is the move that's opposite to what you expect the daily range to be. So if we're bullish and we think it's going up here, we like this movement going down. We love it. Now, you may not feel comfortable buying the London or overnight lows. That's fine. You don't need to. Wait for 8:30. If we drop below 8:30's opening price, and here's the kicker, we're below the opening price at midnight too, we are really, really oversold. Does it take indicators to see that? Nope. Did you require some kind of divergence? Nope. How about a Fibonacci? Nope. Easy, isn't it? Visually see what's being shown here. Below the opening price, you want to be a buyer at midnight. By itself, that's always the basis of what I'm trying to do each day. Then, if we get an 8:30 candle that opens below the midnight candle, and then we have a movement below that, that move here also is like a micro Judas swing for the session of New York. This is a Judas swing on the daily range or the daily candle. So this is basically building the low of the daily candle. This is building the low of the New York session. Both are using the PowerofThree concept, which is accumulation, manipulation, distribution. So what we're saying is this movement below the opening price at 8:30 and below the opening price at midnight, each move lower is the trap. It's the snare that catches traders thinking it's going down. We are looking for that move. We're looking for that drop down, not just any old indiscriminate drop in price. We're looking for a very specific thing. Now I'm down into a 5-minute chart. Same things I had on a 15-minute time frame, I now have just showing and representing it on a 5-minute chart. I want you to take a look at price, study, think about what you see in price action here. Pause the video. If you're not ready, I'm about to begin. Right there. See that fair value gap right there? See these two down closed candles? See that? That's your order block. That's bullish. Your fair value gap. At 8:30, we have a drop down. At 8:30, we're looking to the left and see where are our short-term swing lows, because we want to absorb sell stops, because smart money will pair that with their buys. And we're looking for an imbalance, preferably. And we just happen to have it also with an order block. So we have a lot of things happening here. It comes down, hits it, and then rallies. 8:30, opening price, we find it come back down into it, find some support, and it springs aggressively above these short-term highs. By itself, that right there is enough. That's a beautiful run on S&P, and that would be enough. You don't need to have the objective up here. But if you're holding it for the daily range, you're going to wait for it to reach up in here, and it does so here. Now, in this area here, notice what happens. It rallies up and consolidates during lunch. And around the 2 o'clock hour, going to 3 o'clock, we run back down into sell stops. Traders that have trailed their stop loss up because they don't want to lose any of their profits. And then they pump it one more time up into the PM session or afternoon move into the liquidity that was outlined relative equal highs on the 15-minute time frame. Here is the 1-minute chart. How can you apply what I've been teaching you on the YouTube model? Well, here it is. Okay, the market has a run above this short-term high. So we have a shift in market structure that's bullish. What's this? Fair value gap. It trades down into it, hammers it. 3 consecutive down closed candles. That's what? Your order block. All consecutive, because we're looking at 1-minute candles. That is the order block with the fair value gap. Buy it there. And then comes back down, retests, sends it higher. And then one more time, New York midnight candle opening price. Opportunity again. Trades up into the New York midnight opening candle, trades back into another gap, trades into the midpoint of that, rallies up, consolidates, and then expands up into our objective that was outlined in that 15-minute time frame, the relative equal highs.